Hello friends, let's have a quick recap of what we have studied so far in chapter number 1, that is fundamentals of partnership, right? In detail we have discussed all the topics. Let's have a quick recap. First of all, we had the meaning of partnership, that it is an association between two or more persons to carry on business, to share profits and losses of business, and business is carried on by all or any one of them acting for all. There I explained with an example of a marriage that partnership is just like a marriage. It is an association between two or more persons to carry on business, right? And the business is carried on for earning the profits or for sharing the losses also. Then I discussed the business entity concept, where we have that in the business entity concept, the people who are running the business are separate from the business. The same concept applies in partnership. From accounting viewpoint, partnership is a separate business entity, but from the legal viewpoint, partnership firm is not a separate legal entity from its partners. That is, if the firm is bankrupt, the partners are liable to meet the deficit, right? So we have two viewpoints, accounting and the legal viewpoint. Accounting viewpoint, partnership is a separate business entity, and from the legal viewpoint, partnership firm is not separate from its partners. Clear? Next we have the partnership comes into existence by an agreement, either written or oral. What is this agreement called? This agreement is known as the partnership deed, right? It is a proof of partnership where all the terms and conditions of the partnership are set, right? It is a written document known as partnership deed. Then we have, in case of emergency, a partner has the right to act according to his best judgment and be indemnified for the expenses incurred by him. That is, in case of an emergency, a partner has the right to take a decision, and in that case, if he is incurring some expense, he has the right to be indemnified for that expense, right? Then we discuss the Indian Partnership Act 1932, that in the absence of a partnership deed, the provisions of Indian Partnership Act 1932 shall apply. This is very, very important. The provisions of Indian Partnership Act 1932 in the absence of a partnership deed. Please keep these provisions in mind, right? What are the provisions? That profits and the losses are to be shared equally. Interest on capital is not paid. Interest on drawings is not charged. But interest on loan is paid at the rate of 6% per annum, even if there is a loss. Why? I told you, because interest on loan is a charge against profit. What is a charge against profit? That means it has to be paid whether there are profits or the losses. That's why interest on loan will be charged in profit and loss account and not profit and loss appropriation account. Clear? Then remuneration is not paid to any partner. There are only two things that are to be paid. One is the profit and losses that are to be shared equally. Second is interest on loan, because it is a charge against profit. It is not an appropriation of profit. Clear? Next we discussed profit and loss appropriation account, right? It is an extension of profit and loss account only. Net profit is credited to the profit and loss appropriation account. Interest on drawings are credited because it is an income for the firm. Interest on capital, partner salary, commission, they are debited to profit and loss appropriation account because it is an expense for the firm. And the balance is transferred to partners capital or the current account. Clear? Right? Next we discuss the journal entries related to interest on capital, interest on drawings, salary, everything, right? We discuss transfer to reserve. In the transfer to reserve, we do not have the partners capital accounts. We directly write P&L appropriation account to reserve accounts, right? The partner set aside some amount as reserve out of the profits before appropriation to meet any contingent liability, right? Contingent liability means any liability which can arise in future, right? So we have discussed the journal entries also. Clear? Next we have there was one case where the appropriations may be more than the available profit. We have profit available is 50,000 and appropriations to be done are 80,000. What to do now? Then the profit is distributed in the ratio of appropriations to be made. First of all, what are the appropriations to be made? We will calculate the ratio from that, and in that ratio we will divide the available profit, right? Then we had one topic, rent paid to a partner. Rent paid is a charge against profit, just like interest on loan. We have to pay him rent whether we are earning profits or we are into losses. So rent paid will be debited to profit and loss account and not profit and loss appropriation account. Clear? Just like interest on loan, rent paid to a partner is a charge against profit and not an appropriation account. Clear? Next is, I discussed that we have two type of capital accounts. First is the fixed capital account and the other one is the fluctuating capital account method. Under the fixed capital account method, the capitals will remain fixed unless there is a new introduction of capital, right? Or the capital is withdrawn out of the business. Only in these two cases the capital will change, otherwise it will remain fixed. Clear? So in this case we will prepare two type of accounts, one the partner's capital account and the other is partner's current account. All the transactions will be done through partner's current account. Under the fluctuating capital method, we have only one kind of account, that is the partner's current account, right? Sorry, partner's capital account only, just like the current account under the fixed method, right? And all the transactions will be done through that capital account. Okay, keep in mind, in the absence of any instruction, this method should be followed. Fluctuating capital, not the fixed capital method, right? Next we have interest on partners drawings. I have discussed all the cases in details. What are drawings? Drawings is amount withdrawn from the business for personal use, right? Partnership deed does not provide, no interest is to be charged. If the partnership deed provides for, we will charge interest on drawings from the partners. And how to calculate the drawings, I have already discussed in detail. We will calculate the average period. Average period is time left after the first drawings, add time left after the last drawings divided by 2, and we will calculate the interest for that average period. Clear? This case is applicable where the amount of drawings is equal, the period, the interval of withdrawal is also equal, right? This is applicable in that case only. Okay, so next we have product method. In case the drawings, the amount of drawings and the period of interval is not equal, then we have product method. Amount of drawings is multiplied with the number of months or days it has been used. The product so obtained is total. The interest is calculated on this total for 1 month or day. Now these are few important points that are to be kept in mind. If the date of withdrawal is not given, interest on total drawings for the year is calculated for 6 months on the average basis. That is half of the period, right? If we are not given the date of withdrawal, on which date the withdrawal has been done, the drawings have been done, then we will calculate the interest on drawings for half period, that is 6 months, right? Clear? These are very important points. Please keep these small points in mind because these can be tricky in examinations, I tell you, right? Next we have If the accounting period is less than 6 months, then interest is calculated for half of accounting period. If we are starting the business on 1st of October, then the accounting period is for 6 months only, and interest on drawings will be calculated for half of the accounting period, that is half of 6 months, 3 months only. Clear? Now this is one very important point, that if the rate of interest is given without the words per annum, then the interest is charged without considering the time factor. We'll charge interest on the whole amount. Clear? This is a very very important point, because this is commonly asked in the examinations, which can be really tricky for the students where the journal mistakes are done. Be careful with the words whether per annum is written or not with the rate of interest. If the rate of interest is given without the words per annum, then ignore the time factor. Consider it for full year. Clear? Okay. Then we have interest on partner's capital. Allowed to compensate a partner for contributing the capital. Computed at an agreed rate with reference to the time the capital has been used. Clear? Computed on opening balance. This is very 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 important. Mark this, that interest on partner's capital will always be computed on the opening balance of capital. If we are given the closing balance of capital, first of all calculate the opening balance of capital. How we have to calculate opening balance, I'll show you. Additional capital introduced during the year, the interest allowed for the period it has remained in the business. Now suppose on 1st of April 2016 you have a capital of 5 lakhs, and in the middle of the year, that is on 1st of October 2016, you introduce 1 lakh as additional capital. Then on 1 lakh interest on capital will be paid only for 6 months and not for the full year, because it was not in the business for the remaining half year. Clear? Then it says, if the partnership agreement does not have a clause as to interest on capital is not to be allowed as per the provisions of Indian Partnership Act 1932. Clear? Partnership agreement provides for interest on capital but silent as to the treatment as a charge or profit. Now partnership agreement provides for interest on capital. It says that interest on capital is to be paid, but it is silent whether it is a charge or profit. Right? Now in that case, what is to be done? Interest is allowed only if there is a profit. We'll pay interest on capital only if there are profits. Interest allowed at agreed rate if the profit before interest is equal or more than interest. Right? We have the profits of 1 lakh, and the interest on capital is total of 80,000, then we will pay at an agreed rate. But if the interest on capital is more than rupees 1 lakh, that is the profits, then what is to be done? Then we will divide the available profits in the ratio of interest on capital. Clear? The partnership agreement provides for interest as charged, then the interest to be allowed whether profits or loss, then we have to charge it in profit and loss account and not profit and loss appropriation account. Then comes the opening capital. I told you interest on capital is to be paid on the opening capital. How to calculate opening capital? Capital at the end, add whatever has been deducted during the year, add back loss during the year, drawings, interest on drawings, and subtract whatever was added to the capital, share of profit, additional capital, interest on capital. Then we will reach at opening capital. On this opening capital, interest on capital is to be paid. Clear? Okay. Next, salary or commission to partners. Allowed if the partnership deed allows it is to be paid. Otherwise, as per the provisions of Indian Partnership Act 1932, neither the salary nor the commission or any kind of remuneration to partners will not be paid. Clear? Commission is allowed in 2 ways. As a percentage of net profits before commission, then it is a very simple thing, net profits before commission into rate divided by 100. Or as a percentage of net profits after commission, Then the formula is net profits before commission multiplied by rate divided by 100 plus rate. Clear? At the time of discussing this topic in detail, I have showed you the mathematical calculation of this formula, derivation of this formula. Clear? Then interest on partner's loan. Partner is entitled to receive interest on loan at an agreed rate. In the absence of an agreement, shall receive interest at the rate of 6% per annum as per the provisions of Indian Partnership Act 1932. Please keep this in mind, very, very important. Interest on loan is a charge against profit and not the appropriation. It is to be paid even in case of losses. So, we will charge it in profit and loss account and not profit and loss appropriation account, right? So this is the journal entry: interest on partner's loan to partner's loan, P&L to interest on partner's loan. Clear? In case of a dissolution of the firm, the partner's loan is to be repaid before the payment of capital. Before repaying the capital of the partners, we have to repay the partner's loan, because it is a charge against profit. We have to pay him in any case. Clear? Then I discussed the past adjustments, where the errors or the omissions done in the past were to be rectified through a single entry. Right? We prepared one statement of adjustments, where the adjustments were done, the errors or omissions were corrected, and the net effect is calculated, and then a single journal entry is passed. Then we discussed treating manager as partner with retrospective effect. Right? In this case, we will calculate first of all the adjusted profits. Adjusted profit means the profits according to considering that manager was never a manager, he was a partner. So whatever is paid to him as manager, we will add back in the profits, right? And whatever was payable to him as the partner, we will subtract that, right? We will calculate the adjusted profits, then we will calculate his share in the adjusted profits, right? And whatever should have been payable as the partner, we will add back in that share of profits, like interest on capital, salary, any kind of remuneration, and we will subtract what was actually paid to him as the manager. We'll calculate the difference, right? And according to that difference, we will either pay him or we will either take the money from him. We will either credit his capital account, we will either debit his capital account. Clear? Then one last topic was guarantee of profit. This is an admission of a new partner. He is guaranteed a minimum profit by the partners. There were two cases that the guarantee is given either by all the partners, that is whole of the firm, or by some of the old partners, right? These two cases we discussed with the practical problems. Guarantee of profit, right? Two amounts to be calculated for this: share of profit as per profit sharing ratio and the minimum guarantee of profit. Whichever is higher, we will pay him, right? Higher of the two amounts to be paid. This is what we have studied so far, right? In the partnership accounting, the first chapter is complete. Fundamentals of partnership. With this, the first chapter is totally complete. In the next lecture, we will start with calculation of goodwill, right?